Hello, everyone. Thank you so much for watching this next episode of the Hemlane Hustle. I am very excited for the guests that we have on the show today. Brandon Hall, who is one of the first CPAs that I met in the early days of real estate investing. And one of the things that I most admire is his focus directly on real estate investors, how he can help impact your business and help you understand what tax advantages and savings you can get from real estate investing, as well as just how to think about your financials and the performance of your property portfolio. So, Brandon, welcome. Thanks so much for being on the Hemlane Hustle today.
Thanks so much for having me. I'm really excited to be here.
Fantastic. Great. Well, I know tax season is right around the corner for you. You're already in the thick of it. For those in January, they've hopefully did their 1099s. I want to take a step back before we go into 2023 taxes, what to look out for, all of that. I want to go and just talk about the advantages of investing in real estate and what are the top three tax benefits that you see in investing in real estate. And the reason I bring that up is a lot of real estate investors on this show have two options. They can go put it in stocks, bonds, interest rates are at 5% plus, or they can go ahead and put it into real estate. And so from a tax perspective and advantage, what do you see and what are the three key things that investors should look out for?
Sure. So, real estate is the most, I feel confident saying that, the most tax advantageous investment um, category that you can possibly put your money into. So, real estate's three main tax advantages. First, you shelter cash flow via depreciation, right? So just so I could have rents of 10,000, expenses of 8,000, and cash flow of 2,000. But after depreciation comes into play, which is a non-cash expense, it's a formulaic expense based on the acquisition price of the property. Um, After depreciation comes in, I could have $0 in taxable income. So the first major benefit to understand, and this is true even if I'm owning property directly or via a syndication. So 100% of the property, 10% of the property, 1% of the property, I'm getting these economics. I'm getting a certain amount of rents. I'm getting a certain amount of expenses. I'm getting a certain amount of net operating income. That should be cash flow, unless depending on your debt structure. But after depreciation, I don't have taxable income. So that's advantage number one. I get cash flow today and I don't pay tax on it today,
And
thanks to
Brandon,
depreciation.
sorry to interrupt here. For those who don't understand depreciation, dumb it down to their level, or dumb it down to, that level of, hey, we're new to this. And you're talking about taking the value of what you've purchased and being able to depreciate it over a period of time. So talk a little bit more about how long do you depreciate it for and
Sure.
how much can you depreciate all of that? And then what is depreciation?
Yeah. So depreciation is an annual expense that you get to claim. So it's an annual write-off that you get to claim thanks to owning rental real estate. It's kind of like a privilege thing, like because I own rental real estate, I get to take this expense. But what it's meant to do, it's meant to track the deterioration of your asset over time. So when you buy rental real estate, it's true that the market value increases, right? It goes up because supply is constrained, there's demand, all that stuff, right? So the value of your property is increasing over time, but it's also true that the windows literally fall apart. The roof literally falls apart over time, right? So all the components that go into make the makeup of your building are deteriorating over time, and depreciation is meant to track that deterioration. So it's basically saying like every year you get to take a deduction for this deterioration that's happening. And when you buy rental property, you get to take that deduction for 27 and a half years. Why is it 27 and a half years? I have no idea. That's just what Congress decided. All the smart tax people figured that out a long time ago. So it's 27 and a half years for residential property. It's 39 years for commercial property, office buildings, strip malls, that type of thing. So that's how long you get to deteriorate now or depreciate your asset. Now, the one caveat that I do want to add here is how you purchase your property does not change the formula. Because I get that question a lot. Well, what if I 100% finance it? Same formula. What if I pay 100% cash? Same formula. What if I pay 60% cash and 40% debt? Still the same formula. And the formula is whatever my purchase price is, less the allocation to land. So we have to allocate some value to our land every time we purchase. And that's a big mistake that people make when they buy property, is that they don't actually make that allocation. And it
Mm.
sets you up for audits, right? So you get flagged for audit risk and all that type of stuff. But you make an allocation to land because land does not deteriorate, right? Dirt does not fall apart. It's still the same dirt that it was 27 and a half years ago. So purchase price minus my land allocation, whatever that net value is, divided by 27 and a half years, that's your annual depreciation expense that you get to claim.
How do you know how much the land is? How can you calculate that out?
So technically, you're supposed to go to the property assessor database.
Okay.
So all the counties out there, aside from really Texas, Texas is pretty tough because they've got all like these privacy laws in place. But you're supposed to go to the property assessor database and look up your property. And whatever the most recent assessment was, they'll have like an improvement value and a land value. You apply that ratio. So if the improvement value is 70 and the land value is 30, then the improvement value is 70%, the land value is 30%. And you would apply that ratio to your purchase price. Because oftentimes we're buying property that, that property assessor card that I just talked about values your property at 100K, but we might be buying for 400K. So how do we right size it? Well, you just apply the same ratios of improvement and land. If you don't have access to the property assessor database, you can do land appraisals, you can do insurance cost replacement. There's a couple different things that you can do, but it will open you up to potential audit risk. If you were to be audited, you might have a tougher time substantiating your allocations. But what we don't want to see is, and what we often see is, there's two mistakes. One, I just don't even make the land allocation, either because I forget or I'm just negligent. And that's a mistake. And if you get challenged in an audit, you'll lose. The second mistake that we see is, and this is often a tax pro mistake. So you might not even be aware that this is happening. That's the risk. A lot of what, like, if we get into a lot of mistakes later on in this episode, a lot of the mistakes are like, I trusted my advisor to do this. I didn't even know where to look in the tax return to even see if they did it right. But this is one of those areas. So advisors, tax pros, will just make a random allocation. You'll see online, like if you ever frequent tax preparer forums or Reddits or Facebook groups, there's just like a straight 80-20 that people use. It doesn't matter where you live in the country. They'll just apply 80% to improvements, 20% to land.
Mm.
And if you're in San Francisco, that doesn't work because San Francisco's 60% or 70% to land.
Well,
And you can
makes sense.
lose really,
Yeah.
really hardcore if you ever get challenged, and you own property in San Francisco. So you have to be aware of the various allocations, depending on where you're buying. But the best way to do it is just look at the property tax card.
Yeah. That's great. So that's number one. What is number two for tax advantages of investing in real estate?
Yeah. So number two is also from depreciation. So number one was, we have rents, we have expenses, and then after our expenses, we still have some cash left over. And depreciation shelters that cash most of the time. So that was the first one. Now, the second one is, also most of the time, depreciation, once we factor it in, will actually make it a taxable loss, right? So if we go back to my first example of, I've got $10,000 of rents, $8,000 of expenses. So $2,000 is my net operating income. And then let's say I have $3,000 of depreciation expense. So not only do I get benefit number one, which is just sheltering the 2K of net operating income, but I had $3,000 of depreciation expense. So I actually have a $1,000 taxable loss, my 2K of net operating income plus an extra $1,000. So that $1,000 of taxable loss, the question is, what happens to that? And that's when you go into the passive activity loss rules, which are a beast and very complicated, and where we do most of our consulting as a firm with our clients. But if you can use that $1,000 tax loss against, say, your W-2 income or your business income or any other sort of passive income that you might have, now you get a tax benefit, right? So now you're getting an additional benefit on top of sheltering my $2,000 of net operating income. And then if and I know we're going to talk about this later, but if you put bonus depreciation into this mix, now we're talking about a huge upfront tax loss in the first year. So
Yeah.
so benefit number two is just the ability to claim tax losses, even though my rental is producing net operating income.
Let's talk about bonus depreciation now. We brought it up. Tell me a little bit more. What is bonus depreciation and how have the laws changed there?
Sure. So you can bonus depreciate any component with a useful life of less than 20 years. Now, if we rewind it a little bit, we said that when you buy rental real estate, you do the allocation to land and then you depreciate the improvements, that net value over 27 and a half years or 39 years. So you can't use bonus depreciation on that amount. However, there's something called a cost segregation study. And a cost segregation study is the practice of saying, hey, there are components inside of your property that are not going to last 27 and a half years. There are some components like appliances that are going to last 5 years. There are some components like pavement for parking or concrete or the pool or whatever that are going to last 15 years. Now, why is it 5 years and 15 years? Again, Congress, I don't know. So we're just playing with the rules we've got. So, but those two, uh, the length of time, the 5 and the 15 years, and there's also a 7 year bucket that's kind of sort of phased out. But and I shouldn't say that it's still being used, but not as frequently as it used to be. So there's a 5, 7, and 15 year like timeline on these various components, but all of those are less than 20 years. So what that means is if you can allocate value when you purchase a property, two components with a 5 year life, a 7 year life, or a 15 year life, then they are eligible for bonus depreciation because they all have useful lives of less than 20 years. So people will buy rental real estate and they'll do that initial improvements to land allocation, but then they'll look at those improvements and say, yeah, but of the $1 million that I just bought here, I could actually allocate $200,000 to 5 year property, 7 year property, and 15 year property. And because we have, I guess, 80% bonus depreciation in 2023, 60% in 2024, I can then look at that $200,000 allocation and I can immediately write off 80% of it in the first year. Now, prior to 2023, it was 100%. So this 100% bonus depreciation has been in play now since the 2017 Tax Cuts and Jobs Act. Prior to that, it was 50%. So it's always kind of been around, but the 2017 Tax Cuts and Jobs Act pushed it up to 100%. And then they've written into the act that bonus depreciation phases out starting in 2023. It goes to 80%. This year, it's now 60%. Next year, 2025, it'll be 40%. 2026, it'll be 20%. 2027, it'll be zero. So bonus depreciation is being phased out. It's going away. There's currently a tax bill sitting in Congress that will make it retroactively 100% starting 2023 and then push the phase out, I believe, to start in 2026 or 2027. But we don't know where that bill is going to really end
Where
up.
that is, when it's gonna get approved,
Yeah.
and then you have to go back and restate your 2023, correct?
Yeah, we've all been sitting on a bunch of tax returns, and
Yeah,
we're like,
waiting.
should we just get these things filed, or should we keep waiting? So it's kind of an interesting challenge that Congress has decided to throw all of us CPAs this year. But yeah, but if it's retroactively made 100%, that's great for real estate investors because it just means that you'll get a lot more out of your properties when you acquire them.
Yeah, yeah, definitely. Fantastic. So if listeners are not convinced on buying more real estate based on depreciation here, what is your third and final advantage of investing in real estate?
Just the fact that you can kick the tax can down the road for forever. I mean, you can buy property today, and well, let me actually back up for more realistic examples. We have a lot of clients, and myself included, that bought property between like 2015 and 2019. And then what happened in 2020, 2021, and 2022? The real estate market shot up like 50 to 60% during those 3 years. Well, if you had bought property 2015 to 2019, I mean, you're looking pretty right now. You made a lot of money in equity, right? And you didn't do anything. You could be the worst operator in the world. We actually see some pretty bad operators that got bailed out simply because the market shot
Of the
up and
market.
and everything appreciated, right? So that's great. But the question is, how do I liquidate that? And the answer is you don't really have to. Like what's happening right now is people are looking at their portfolios and they're going, all right, I bought in 2017 and now my return on equity each year is like 2%. It's worse than T-bills. So I've got to reallocate this. And it's only worse than T-bills because the appreciation was so impactful. Now I've got so much equity sitting in this property. What do I do? And what we consult on is how do you liquidate that and not pay the gains on sale. And so there's a couple ways to do it. You can do a 1031 exchange. That's the most formidable way to do it. There's rules to doing a 1031 exchange. You have to identify property, then you have to close on property within a certain amount of time. Tough to do, especially in this type of a market. There's something that we call the lazy man 1031, which is where you just sell the property outright. You don't do the 1031 exchange, and then you buy the replacement property within the same calendar year. You do a cost seg study, get the bonus depreciation, and you're going to create a big tax loss to offset the gain. It's effectively a 1031 exchange because you kind of end up in the same spot, but you're
Yep.
not doing a 1031 exchange. And then you can invest in qualified opportunity funds and roll the gain. The point, though, is just that there are multiple ways to liquidate real estate and to change up your holdings to optimize for return on equity without having to pay tax. And you could do this until the day that you die and then pass it all on to your heirs, get a stepped up basis, and they could liquidate everything and not pay any tax. So it's just when you think long game, and I know it's really hard for people to do, myself included, we want everything now, right? But if you do think long term, if you think in terms of decades, there's no better play than real estate, especially from a tax perspective.
Yeah, I love that. And I couldn't agree more, Brandon. Question for you, because we're in the convenience culture, and the convenience culture, for those listening who haven't heard of it, it's that you want things and you want them now. You've got Instacart to deliver your food, you've got Amazon to deliver anything you want online. And it's to the point where you expect things to just be brought to you and instant gratification on things. And so when you think about real estate investing, directly investing in purchasing a single family home or duplex or fourplex, it's quite a bit of work. You can't, well, there's some great websites out there to do it, but you can't just go online and click purchase and then get that investment property. And there are definitely websites that do it, like the roof stocks of the world. But it's not common practice. Most folks in for their particular markets are having to every day do the diligence on their property, calculate out what their cap rate is, and what their cash flow is going to be to make sure they don't have what Michael Zuber calls an alligator property. And so now there's been a trend of syndication and saying, great, let me just give someone else money. And I don't have the physical property. I'm just an investor, an LP in this. Are there more tax advantages if you do direct investing, or can all of these tax advantages you spoke about somehow from the syndication, does that get back to the LP, or not really? And actually the direct investment of physically buying a property or on your own as a single member LLC or multi-member is a better way to go. Walk me through how you would think about that, being someone who's looking to get into real estate.
So, just a general life philosophy is anytime that you give up control, you lose flexibility. So, when you are investing in a syndication, you are giving up control. You don't get to tell the GP what to do. It doesn't matter how many times you call or how loud you yell. The GP runs the show, right? So that doesn't necessarily mean that you lose tax benefits. You're still going to get all that pass through depreciation just on your whatever your percentage share of the deal is. That's what you would receive. There are some limitations in terms of debt finance distributions and losses that you might or might not be able to claim. So that is one thing to watch out for. Like if I put 100K into a syndication, I might not be able to take losses of 120K. I might be capped at only taking losses of 100K, depending on how the syndication is structured and who else is getting allocated losses. That's too complex for this. But the point is that you're still getting the depreciation benefits. So benefit number one and number two that we talked about. Where you start to lose is benefit number three. So you don't get to dictate that 1031 exchange process. You don't get to dictate the timing. And here's an example. You could get a surprise, like the syndicate could get a surprise offer that's incredible, right? And it's going to make not only the GP rich, but the LPs a lot of money too. And that offer could come on, I don't know, November 29th, and they want to close on December 28th or something. Well, if that happens, you as the investor have zero time to do any sort of tax planning. So when they liquidate this, you're getting gain allocated back to you and you're going to take it on the chin. You can't do a 1031 exchange. You can't 1031 exchange partnership interests, which is what you own when you own a stake in a syndication. You don't actually own the underlying real estate. The partnership owns the real estate. So because you don't own the real estate, you own this interest in a partnership. You can't 1031 exchange that interest. So the only thing that you can do is try to buy another stake into another syndication to get allocated losses to offset the gain on sale. But likely that's too late. It's too compressed of a timeline. So that's where we see LP investors lose in the tax benefit
Mhm.
conversation. It's still highly beneficial. Don't get me wrong. Like you're still getting all the benefits, but where you lose is the flexibility on the timing of the liquidations and not having enough time to tax plan around that.
Yeah, makes a lot of sense. And then entity structure and all of that is something for us to go into at a different time.
Yeah.
Let's just say I have two rental properties or one rental property. What is the number one thing that you see people at this stage mess up on?
Oh, geez. If you have one or two rental properties, I'll give you two things. The number one thing that we see people mess up on is the passive activity loss rules, which I kind of talked about earlier. Very complex set of rules, but that those rules dictate whether or not you can take the losses from your rental. So if you recall, we were talking about a $10,000 rental income, $8,000 in expenses, $3,000 of depreciation expenses. I made money, right? I made actual cash flow, but I tell the IRS I lost $1,000 thanks to depreciation. But can I use that $1,000 of loss? That's the real question. And to get a yes or no, you have to walk through the passive activity loss rules and understand how they apply to your situation. So the number one mistake that we see is people not understanding how to navigate the passive activity loss rules, and further hiring advisors that also don't know how to navigate the passive activity loss rules. I mean, we see people that have full-time jobs that are writing off all their income from the rentals that they're buying, where the passive activity loss rules would prohibit that.
Yeah.
And that just it's exposing you to a lot of risk that you probably don't even understand. You got back tax. If you get audited and lose, you got back taxes, interest, penalties. It gets very expensive. So that's mistake number one, is understanding the passive activity loss rules. Mistake number two is something called partial asset dispositions. So when you buy a rental, the rental, even if you don't do a cost segregation study, the rental still, you still technically have value that should be assigned to every single component, right? So that's what a cost seg study formally does. But even if you don't do a cost seg study, the roof literally has some value assigned to it. That's still a true statement. Um, so if you replace the roof like 3 or 4 years into the hold period, and you don't write off the cost of the roof that no longer exists, then you're effectively now depreciating two roofs, even though you only have one. So what that write-off process is called a partial asset disposition. It's basically whenever I replace a big component of my property, I'm going to figure out what the value of the old piece that's no longer there that I literally ripped off, figure out what that value is. I'm going to write it off on my tax return. That never happens. You could send me 1,000 tax returns with real estate on them, and I bet you 998 of them are not doing this.
Yeah. Those with the rental property should only go to a real estate CPA, because do you feel like most accountants just the level of detail is not to this extent?
Yeah, yeah. I mean, and honestly, it's something that we struggle with because we have a lot of people that call us on a monthly basis wanting to be a client of ours. We price at a higher tier than I think what you would expect a CPA to price at. And there's a variety of reasons for that: client experience, high quality, all that.
Mhm.
But where we have struggled, especially recently, like the last few months, is when we know that we could otherwise help people, but they are like, man, I just don't want to pay that price. We're almost like, just do it yourself then. because and I know that's a weird thing to hear a CPA say, and you're probably like, oh my gosh, I'm gonna make so many mistakes. But for us, we're like, man, like we've just seen so many mistakes from accountants,
Yeah.
CPAs, EAs, not credentialed pros. Like everybody makes these mistakes, and we've made mistakes too. But like if they're not doing real estate tax returns day in, day out, they're not gonna catch carry forward losses, the passive activity loss rules, partial asset dispositions, and you're not going to be optimized. And so it's almost like if you've got a handful of properties, like you should spend 15, 20 hours powering through TurboTax, and at least you'll understand exactly where everything's is in your tax returns. It's going to take you some time to really figure it out, but so we struggle with that. It's like, yes, you should use a real estate accountant, but like also don't use somebody that's going to charge $800 for something that's complex, because then they're charging everybody $800 and they're not going to give you the attention that you need with this complexity. So you almost and
Yeah, you
it's,
get what you
it's
pay for. Yeah.
yeah, yeah,
We
it's
always we
yeah,
always tell people that you get what you pay for. That's great. Accounting and finance degrees with rental properties. So there are both you and I come from a finance and accounting background, but there's so many real estate investors who I meet where, they took an accounting class and that's a huge difference versus being in it day to day. And when you talk about security deposits, and those are actually on the balance sheet and a liability and all
yeah.
of this stuff, it's almost a little bit too complex if you don't have someone sitting there holding your hand. What do you recommend for those who don't have an accounting finance degree? Do you think they need them, or do they just need a really, really strong CPA like yourself, Brandon?
You definitely don't need an accounting or finance degree. I mean, if you don't mind reading and exploring, then you will be able to get the fundamentals enough to like prepare your own return, do your own books, to a certain point of scale. And that certain point of scale is different for everybody, right? It might be 2 properties, might be 1, might be 15. We have some people in our firm or some clients that do their own stuff and they're managing 50 properties, right? So it really just depends on how you value your time and what your skills actually are. But I do think that you have to invest in understanding the basics. And I thought you were gonna ask me, like, should the accounting finance degree people use a CPA? Because my answer was gonna be, yeah, they should. I
Yeah.
actually outsource my own tax returns and my books. I don't
Okay.
do my own stuff, and I actually think that it makes it even better because I know what to look for, but I'm just reviewing the output. I'm not actually spending all the time on the data entry and the details. So I'm optimizing my time and I know what to look for and I'm getting another professional set of eyes on it. And we actually get to like collaborate in a different type of way. So I would say everybody should be using professionals, but even if you're not accounting finance degreed, invest in invest in fundamental understanding of taxes, accounting, and personal finance so that you can have more sophisticated conversations with your advisors.
Yeah, yeah. No, I couldn't agree more. And to that point of, I actually am not surprised that you use another a tax accountant to do your own, because to your point, you need to balance that of your time, but also for you having a third party do it and you're reviewing it makes a ton of sense also from an audit perspective and all of that. It helps you sleep at night knowing there's two eyes on it. Um,
Absolutely.
Great. Final question for you. With taxes around the corner here, hopefully everyone has already started with tax season. What do real estate investors need to know? And then also finally, how can they reach out to you if they have questions?
So with the tax bill that's currently sitting in Congress,
Mhm.
the number one thing that I'll say is if you bought property and placed it into service in 2023, you should very seriously consider filing an extension on April 15th and waiting until this tax bill is decided in Congress to actually file your returns. If you don't, then you will have to amend your returns later. And if you're paying an accountant, I would hope that they would not do that for you for free because their time is valuable. So, you know, we are kind of stuck right now between a rock and a hard place. All of our clients want their returns done and they want the refunds in hand. The problem, though, is that if this tax bill passes, we're going to have to recalculate all those returns.
Yeah, double
um,
work.
yeah, so that's the number one thing. Like, if your accountant this year is saying, "Hey, we need to extend," I would probably like if you bought a property and placed it into service in 2023, seriously consider extending. Otherwise, you might end up paying more professional fees for services to do that amendment later on once this bill is finalized. That's probably the number one thing. And the second thing is just if you can, it's too late for this, but in Q4 of this year, if you don't have like some sort of service plan with a professional and you do more like ad hoc, call them up with questions, I would try to schedule like 2 phone calls, November and December of this year, to go over your income streams for 2024
Mhm.
and how do the passive activity loss rules apply to me based on me buying property in 2024 and placing it into service, because that will help you understand what you are going to owe in Q1 of next year. So if you can kind of get the income out on the table, in a good understanding of how the passive activity loss rules apply to you, and do this every single year, then the following Q1 of the following year, when you have to pay your tax bill, you might actually find you don't have to pay your tax bill, or you
Yeah.
have to pay a much smaller amount, or you're even getting a refund. So we like to try to have those conversations with our clients in Q4 of each year, so that there's no surprises the
So
following year.
put that on your calendar in Q4 to reach out to Brandon.
Yes.
Brandon, thanks so much. If folks have any questions of how Hull's CPA can help them, where should they go?
Yeah, so you can go to www.therealestatecpa.com. We have a lot of resources. We've got a big button that says, let's get started, become a client. You're also welcome to email me. My email is brandon.hall@hallcpallc.com. So either one of those is great.
Great. Well, thanks so much, especially during the busy tax season, for jumping on the Hemlane Hustle. And we look forward to the next one.
Thanks for having me.